Hi, this is Doug Heikkinen from Iris.xyz here in San Francisco at the Hightower Apex Conference. And I'm here with Larry Pitowski, the co-manager of the Good Haven Fund. Hi, Larry.
Hi, Doug.
The Good Haven Fund was up 20% last year. Wow. What was that all about?
You know, Doug, we did what we often do, which is we were fishing in the prior year and a half in very unpopular waters where the headlines were negative in areas like energy and mining, and where we found a bunch of bargains and where our research turned out to be accurate. And so that led to a very good result in 2016 after a lot of hard work in 2015.
So is the fund particularly attractive now?
You know, we think it is. The future returns of any asset are very much affected by what you pay for it. If you look at the S&P as a proxy, the S&P is trading at around 20 times earnings. And I think the future returns from that level are likely to be mediocre. Our portfolio is much more undervalued than that. We have some cash. We have some securities in there that really normally don't behave with the market overall, and I think that gives us the chance to end up with a much better result versus the market over time if we've done our jobs well.
Recently, we've heard a lot about active versus passive, and with the long bull market run, is active still a play?
You know, I think today, given where the S&P is selling, I think people should be looking more at active, and ironically, the majority of people have been pushing a little harder into passive lately. We don't think there's anything terribly wrong with passive, even though it's not what we do, but we find the acceleration of that trend near what are very high market valuation levels any way you look at it perplexing. We think today people should be looking for active managers, be it us or anybody else, who really does not resemble the market. We think that is a way to potentially have better returns over time from these market levels.
You said that managers should look less like indexes. Can you explain why?
Well, first of all, I think if you're going to just mimic the index, I think people should just go with an index fund where the fees are much lower. So I would not, if I was on the outside and not in the business, I would not really want to have somebody who mimicked the index but yet was running an active fund. But I think to get a different result over time, you need to look different than the market. And if you're striving to earn different returns on the upside than the market, you have to construct a portfolio that looks different. You just have to be right about your research and analysis, which we've been fortunate over many years we've been able to do.
What would you tell advisors that a concentrated value approach is the way to go right now?
I think what attracts us as investors, and my partner and I are the two largest individual investors in the Good Haven Fund that we're aware of, so this is not a philosophical or an academic exercise. I think we are very focused on the downside. We're looking for investments where we have a lot of upside, but we're also very concerned about the downside. And I think from these market levels, I think it's important to be invested in a portfolio that is thinking about what could go wrong, that is not stretching on buying things, and that has some dry powder to take advantage of what will inevitably be market volatility on the downside from time to time.
And how can people find the fund?
The fund, the symbol is GoodX. It can be purchased at any number of places. My partner and I are substantial investors, again, alongside our fellow shareholders, and we are always available to answer any questions from shareholders that they should have.
Sounds great. Thanks so much for being with us today.
Thank you for having me.
Take care.